Hey, good afternoon, everybody. Again, this is Carl from Mountain Seed. Really appreciate everybody coming on to the call this afternoon. And I know we've got a decent amount of folks that are Mountain Seed clients on the phone. So as always, appreciate your trust in us, and really excited to welcome Angela Lucas to the call this month. Angela and I bumped into each other, I guess, a number of months ago with some mutual clients and folks she was working with up in the Northeast, and they were singing her praises. And so, whenever I hear of somebody that's doing good work, always want to expose those folks to our clients, just to better your business. So, won't steal any of her thunder, but just a little bit of background. So Angela started the firm Sterling Compliance a couple of years ago, but prior to that was with the OCC as an examiner, specializing in consumer compliance and commercial credit. Her firm, Sterling, she started with a long time, I think, client, right, Angela? And they've been doing great work. We were talking just before the call about how the business has been taking off in recent years, and so I think she's got some really good things to share with us. I know there's some folks on the call that are clients of hers as well, so appreciate you guys. And without further ado, I will turn it over to Angela.
Thank you so much. It is so exciting to be here today. And this is actually one of my favorite topics. I think only us compliance nerds can talk about flood like it is a favorite topic, but it really is because one of the things that we had put into this webinar and wanted to talk about is why do we even need to address flood compliance? And, as an examiner, my examiner days were a long time ago, and I do not even want to admit when they were, because it just means that I'm getting older. But there were three statutes as an examiner that you learn, like, oh gosh, you don't ever want to mess these up as a banker. So, Reg O, the legal lending limit, and flood. And why? Because there are stiff penalties that come along with these things. So we want to make sure that everyone has a really good understanding of flood compliance. And, there is some overlap whenever we talk about flood insurance and appraisals and why does it matter. So we really wanted to give everybody a good understanding of why they intersect and what the value is to you and really communicating with your appraiser when it comes to flood insurance. So I'm going to start you with a little bit of background. My husband is a history teacher, so I get a history lesson pretty much every day. So I will give you one as well. So we've had flood in place since 1968. So from 1968 to 1994, that's where we had all of our traditional flood insurance requirements. So, whenever we make, increase, extend, or renew a loan that has a property located in a flood zone, we have to have it covered by flood insurance. And all of the requirements to come into place with that. In 2012, this is when Biggert Waters was released, and oh man, it hit. I mean, this was a huge issue in the industry whenever this came out. There were a couple of things that it did right away, which weren't entirely horrible. One of the things that it did was it allowed you to change the way that you force place flood insurance and charge customers for that force place flood insurance. And that was actually a good thing because prior to that time, you had to send out your letter when you identified a lapse in coverage or insufficient coverage. You had to wait 45 days for the customer to respond to give you evidence that they have their own insurance in place. And then if they didn't respond, you had to force place. Well, what happens during that 45-day period? So, there's a lot of risk in there. And so what Biggert Waters said, okay, whenever you identify a lapse in coverage or insufficient coverage, you can force place on that date and then charge the borrower for that force place insurance from that date as well. So it was actually a good thing that happened there. One of the other things that it did right away was that it increased the premiums that you would pay for violations of the Flood Act. So for individual violations, depending on who your regulator was, your per violation fee could have been $350 to $385 per violation. And then there was a max on how much you could be fined for systemic violations. So, if you had systemic violations that were going to aggregate to way more than the maximum limit, you could say, okay, we're just going to get the maximum limit of fines here and move about our business. Well, What Biggert Waters did was it put everybody on a level playing field as far as those individual premiums are concerned and raised it to $2,000 per violation. So it was a significant increase, and then removed that cap over the whole. So if you have systemic violations, the sky's basically the limit as far as how much you could be fined for those violations. The worst thing that Biggert Waters did was that, and the act, not the people, what it did was it started removing the subsidized premiums for the flood insurance. And when it did that, you would have customers that had $3,000 flood insurance premiums, and all of a sudden they have a $33,000 flood insurance premium. They couldn't afford it. They couldn't pay for it. It was insane. And so they said, all right, this is harming consumers. This is harming the industry. What are we going to do about this? So they dialed it back a little bit. And in 2014, we got the Homeowners Flood Insurance Affordability Act. And so we stopped those subsidies from being phased out. And they put into place some provisions that required better infrastructure and better administration of compliance with the flood, with the Flood Act. So that kind of gives you a backstory of where we are. I'll take you through all of the requirements that are still in place and some of those that are proposed as well. So when we talk about flood insurance eligibility, basically under the National Flood Enforcement or Insurance Program, the flood insurance is available for improved real property or mobile homes that are located or to be located in special flood hazard areas. So those areas are the darkly shaded areas that have a 1% or greater chance of being flooded at any time. And so that's what a flood map looks like. Right now, it's much easier. You get a flood determination. We'll go through that whole process. But, we used to, I'll never forget, a few years ago, I ran into a client and they had an issue where they were trying to read all of these old flood maps and making their own determinations. And they've been doing that for years. And then they transitioned to getting the automated flood determinations. And they found out that a whole bunch of the loans that they had made were actually in flood zones that had changed. And so whenever we were looking back, I'll never forget, we had this conversation. They said, well, the guy that was here previously, he would just go out and he'd be like, well, the property is not that close to the creek, so we're good. It's not a flood zone. And that's how they were doing their flood determination. So it's been an interesting evolution. So one of the things that's required under the NFIP, if you're going to use NFIP funded insurance, is whether a community participates in the program itself. Now, FEMA conducts studies to determine which flood hazard areas are in the United States. Then they issue flood hazard boundary maps and flood insurance rate maps to those communities. And they notify those communities that, hey, you have these flood zones in there. And then those communities have to establish their eligibility by putting in an infrastructure, basically adopting and enforcing floodplain management ordinances. So they go through this whole process of being eligible to participate in the NFIP. Now, what you probably see periodically are those communities that get suspended, because they get suspended whenever they don't uphold their floodplain ordinances. Now, whenever we just had NFIP insurance available to us and we had to adhere to NFIP requirements, that was a big deal, because if we were going to do a loan and it was in a flood zone and that community did not participate in the NFIP, we had to make the decision, do we make the loan, do we not? Do we take on this risk? Are we going to be cited from a safety and soundness perspective for making this loan? And now we have so many other options available to us as far as private flood insurance is concerned. So now it's not as big of a risk if the community doesn't participate. So let's talk eligible structures. Residential, industrial, commercial, or agricultural buildings that are walled and roofed. Under the FEMA rules, if a building has 2 walls and an attached roof, it is insurable, regardless of how run down and dilapidated it is. Buildings under construction or for which a development loan is made to construct insurable improvements would be covered. Mobile homes affixed to a permanent site, including those that are part of a dealer's inventory and affixed to permanent foundations, would be eligible. And then our condominiums and our cooperative buildings are also eligible. Ineligible structures are mobile homes that are not affixed to a permanent site, buildings entirely in, on, or over water into which boats are floated, because what would be the point? And then buildings that are newly constructed or substantially improved on or after October 1st of 1982 and are located in these coastal barrier resource systems. If you are unsure whether your property is located in one of these systems, you can Google coastal barrier resource systems and FEMA. It brings every single one of them up by state, so it's very easy to find out this information. Now, here's our purchase requirements. When all of the following factors are present, it makes a loan a designated loan. That means under the flood rules, you absolutely have to have flood insurance in place. So when you're making, increasing, extending, or renewing any loan that's secured by improved real estate or a mobile home that's going to be affixed to a permanent foundation or already is, that property is located in a flood zone, and that community participates in the NFIP, you absolutely have to have flood insurance in place. There are some exceptions to this, however. If the property is located on state-owned property that's covered by a policy of self-insurance and meets FEMA's requirements, it may not have to have that flood insurance in place. If a loan has an original principal balance of $5,000 or less, or an original repayment term of 1 year or less, it does not need to be covered. Now, this goes according to original terms. So if a loan has paid down to $4,000 and only has 6 months to go, you still need to have it covered. And then we have this detached structure exemption. So we're going to go a little bit more into that later. So I don't want to steal too much thunder from the later slides. But we do have this detached structure exemption now. So here's our required form. This is our standard flood hazard determination form. This is the form that I had mentioned that other client wasn't necessarily getting. Basically, this is when you are making, increasing, extending, or renewing any loan, doesn't matter whether it's commercial or consumer, you get this flood determination. This is going to tell you what the flood zone is. It's going to tell you whether it's in a flood zone or not. And you need to keep a copy of this form, either in hard copy or electronic form, for the period of time you own the loan. Now, the deal with this form as well, a couple of compliance considerations to keep in mind whenever you see this form. You want to make sure that you're tying the property address that's listed on this form to the property address that is securing your loan. We have come up with instances where the property addresses were different and the flood determination was pulled for the wrong property. This can sometimes come into play with home improvement loans or loans with multiple properties involved. You also want to make sure that your lender number is included on the form itself. And then the other thing about the form is that it actually also certifies or brings into place your life of loan feature. So it monitors that life of loan feature, follows with your loan for the entire time that you own it to notify you if the flood zone has ever changed. Now, the date of the determination is absolutely critical, and we're going to go into why that is. Now, you can use prior determinations. You are not required to use prior determinations. So it is a policy that you need to make or establish at your institution whether you're going to use prior determination. So if you're going to, you can get a previous determination if the previous one is no more than 7 years old, there have been no changes to the flood map, and it was recorded on that standard flood hazard determination form. But if you're making a new loan, you cannot use a previous determination. You have to get a new one. Now, some institutions say, you know what, we're just going to make this easy for our staff, and we are just going to get a new determination each time, and that's fine as well. Now, here's why the timing is absolutely critical, and that little date on that determination makes such a big difference. You have to give notice to your customer that they're located in a flood zone. And you need to give them reasonable notice so they can kind of shop around. You know, when we were limited to NFIP insurance, you know, there's not too many options. But now we have so many flood insurance options available out there that they really need to shop around and compare the deductibles and the premiums for what's out there. So we want to make sure that we're giving them enough time, shop around, make an educated decision on their flood insurance, and get that into place prior to closing. So we need to have a sufficient time frame lapse between there. The other issue is the sooner you know that a property is located in a flood zone, you can communicate with your appraiser, or you can put together an action plan on how you're going to get to your appraised value. Because whenever we talk about insurable value, which is one of the items that is factored into the calculation for your flood insurance, the appraisal becomes a primary component of that calculation. So if you know it's in a flood zone, you can get to your appraiser early, talk to them about what you actually need. And most times, if we're looking at that Fannie Mae, Freddie Mac appraisal form, we're looking at the cost approach. We need that cost approach. And a lot of the times, the appraisers won't complete it if it really doesn't apply to the property. But if it's in a flood zone, it could. And we'll talk about why. Now, you can charge fees for the flood determination and the life of loan monitoring fee whenever a borrower initiates a transaction. So if it's a new transaction, if you're increasing, extending, or renewing a loan that triggers that hazard determination, you can pass it along to the customer. If FEMA has revised or updated flood maps for an area, or the determination results in the need for force-placed insurance, you can pass those fees on to the customer. Now, you have to be cognizant whenever you are putting your fees into your calculations for prepaid finance charges, only the life of loan monitoring fee should be included in your prepaids. So, sometimes we'll see, well, the determination and the life loan monitoring fee are not broken out separately. We get both for $9. That's fine. You put $9 in for your prepaid finance charge. But if your determination is $6 and your life of loan monitoring fee is $3 and you have that breakdown, only that $3 should go into your prepaid finance charges. And that comes from the commentary from Reg Z, or the Truth in Lending Act. So we do have some notice requirements. We have to let the customer know that the building or the mobile home is or will be located within the flood hazard area. We have to give them a description of their purchase requirements for getting that flood insurance in place. Let them know that coverage is available through the NFIP and could be available through private insurers. And basically letting them know that if there's a federal disaster, they could be eligible for federal disaster relief. Again, the notice has to be provided within a reasonable time frame prior to closing. Rule of thumb is 10 days. Now, if this is a refinance transaction where they already have flood insurance in place, that 10-day time frame could be squeezed, but you don't want to get it the day before closing or the day of closing. Additional notice requirements came into place in January of last year. So flood insurance, we had to let them know, is available from private flood insurance companies that issue standard flood hazard insurance policies on behalf of the NFIP, that it provides the same level of coverage, and basically they need to look at the coverage, the deductibles, exclusions, conditions, and all of the other terms and conditions of those private flood insurance policies to make an educated decision. So here's where we get into the calculation of flood insurance. So we know the calculation goes to lesser of the maximum available under the NFIP, the insurable value, and the outstanding balance of the loan. So here are our NFIP coverage amounts. Here's what they tell us. So if we have a 1 to 4 family dwelling, we have a $250,000 per structure coverage piece here. This is our minimum required. For our commercial properties, our non-residential, or for other residential, like our multifamily properties, it's $500,000 per structure. Now, contents coverage for residential is $100,000 per structure, and then non-residential for our commercial properties is $500,000 for the coverage piece of it. Now, the issue here is that you see this nice little column in yellow in the middle that talks about the emergency program. The emergency program is not the program that comes into play during a federal disaster. The emergency program is not all that well named because this is when a community is just being mapped into the NFIP. And so while a community is putting its infrastructure in place and its ordinances in place, your customer is not eligible for getting the full amount from the NFIP during that time frame. So they would have to supplement with some other kind of coverage during that time frame. Here's where the appraisals matter when we talk insurable value. And I've had so many clients come to me and say, I talked to my appraiser and they said I can't give you the insurable value because the insurable value is an insurance term. And that's true. But when you break it down to what's actually in the appraisals, that's where the communication needs to happen. So our replacement cost value is going to be used for our primary residences only. This is where we use the cost value minus the land. So if you know early enough that your 1 to 4 family dwelling is located in a flood zone, You can have your appraiser come up with the cost approach, and then you have the site value there as well. You can get your replacement cost value relatively easily. Now, replacement cost value, again, is only used for our primary residences. If we have secondary residences, vacation homes, commercial structures, or contents, we have to look at the actual cash value. So if you have a 1 to 4 family rental property, so non-owner occupied, or a secondary or vacation home, you're looking at the actual cash value. Now, you're probably getting a similar appraiser as that you see right there on the slide. You can get the cost approach minus land, minus physical depreciation. Boom, you have your actual cash value. But it's inevitable that you're going to have a commercial structure that has one of those big old commercial appraisals that nobody likes to analyze. I remember having to analyze those things whenever we were doing asset quality for our banks when I was an examiner. It was just miserable looking at those commercial appraisals. No offense to the commercial appraisers on the line, but there's a lot of data in there. And so you can ask your appraiser to come up with this value. And again, it is the cost value minus the land minus the depreciation. You can ask for that actual cash value, and that way you don't have to go hunting for it or try to calculate it on your own. So now we can kind of get into, it never fails that there's some kind of complex situation that you run into and you have multiple structures, they're all in a flood zone or just one's in a flood zone, and how do you get it covered and what do you do? So we have a couple of scenarios built into the training today, and we have two right here. The first one has 3 structures, all 1 to 4 family structures. The value of the first one is 20,000. The value of the second one in the middle is 50,000, and the value of the third one is 10,000. But our loan amount is only $50,000. The maximum available under the NFIP is $250,000 per structure. So when we look at the lesser of the 3 values, we're going to come to $50,000 as our maximum or our minimum required under the NFIP. So now we have $50,000. What do we do? Well, we have to spread it among these 3 structures. They don't care how you spread that coverage among the 3 structures. They just each have to be covered. So you just want to make sure that whether you're using square footage, whether 2 are one is your primary collateral and the 2 are kind of like an abundance of caution, you can do it that way, but you just have to document your file. Now, what happens if there's greater dollar amounts involved? Now, here we have 2 commercial properties. The first one is valued at $500,000 and the second one is valued at $250,000. Our loan amount is $3 million. So the maximum available under the NFIP is $500,000 per building. So if we're looking at that, if we have $500,000 per building, that's $1 million coverage together. We have a $3 million loan amount, and then we look at their values. Really, it's $750,000. So you're going to cover the first one, our little cafe, for $500,000, and then the other one for $250,000. I know that was a quick run through. We have a couple other scenarios that I'll go much slower through, and you also have all the data in the slides that you can refer back to as well. Okay, so contents coverage can be a little sticky wicket here because when you take a lien on real estate and it's in a flood zone and you're also taking the security interest in the content, so your equipment, inventory, anything else, you have to have coverage on those contents. If you are just taking an interest in the business assets only, not the real estate, you don't have to have contents coverage, even if those contents are in a flood zone. So you're not going to, if you're just doing business assets, you're not going to pull a flood determination because there's no real estate involved. Well, of course, I was delivering some flood training to a bunch of commercial lenders, and they said, well, what if our customer did a warehouse loan last year to finance their warehouse, and we know the warehouse is in a flood zone, so we have flood insurance coverage on that warehouse, and they came back this year and we did an inventory loan for them, and the inventory is located in that warehouse. Do we need to have it covered? And I was like, you got to throw a curveball, but I don't know that your regulators would put 2 and 2 together where that's concerned, but if you have knowledge that your contents are housed in a warehouse that is in a flood zone, I would recommend you get it covered. Even if it's not required under the flood rules, safety and soundness says you want to protect your collateral and you want to make sure that it's safe in the event of a flood. So I would say get it covered. Now, blanket insurance is kind of, I don't want to say it's falling by the wayside. My insurance friends in the industry would not be happy for me to say that. Um, but we saw this a lot covering that time frame between sending the letter to your customer and force placing insurance. We don't see that as much anymore because you can force place earlier. So, the regulators don't like blanket insurance because it only covers the bank's interest and not the consumer's interest. And there are some very specific limitations to blanket insurance, and in some cases, I know I know we're talking flood, but on the hazard insurance side, you have to be careful because the blanket insurance sometimes requires you to foreclose on a property before you can make a claim on that property and things like that. So you want to be really careful with the blanket insurance, but it is something that's still out there. So on our construction loans, we got to have them covered. So we have two options. We can either require the purchase of the insurance at the time the loan is made for the full amount of the loan, or we would provide coverage or get coverage for each specific drawdown. The second option is way more complicated, and you are going to have to be so closely monitoring those construction drawdowns and getting new insurance in place, increased insurance in place before any monies are extended out of that construction account. It's not even worth going down that road. You would want to, our recommendation would be to require insurance for the full amount of the construction loan at the time it's made. For second mortgages and home equity loans, as a subordinate lien holder, you have to coordinate coverage through the borrower and the insurance agent of record. Now, your interest is established by an endorsement to the existing policy. Sometimes they'll list you as another mortgagee, sometimes not, but you do get that endorsement. Now, if you find that the first mortgagee has not required sufficient coverage, you have to protect your security interests as the subordinate lien holder to purchase additional coverage. So you're going to have to talk to your borrower about purchasing additional coverage. Now, the amount required is going to be the amount of all the outstanding liens. So going back to our flood insurance calculation, we're not just looking at your loan amount as the outstanding balance and calculating the flood amount. You have to look at all outstanding liens for that property as well. Home equity lines of credit, or any open-end line of credit for that matter, you have two options, but only one we truly recommend. This is very similar to the construction loans that we were talking about. So you can either review your HELOC records periodically and make sure the flood insurance is consistent with the draws, or just require flood insurance in the fully committed amount. It will never fail that if you choose option one, your customer has drawn on their line of credit and you don't have current flood insurance in place for an adequate amount, and your examiners come in and they pick this loan for their testing. So you want to be sure to get the fully committed amount for your minimum required for your flood insurance. Now, here's the detached structure exemption that I had been mentioning at the beginning. This was something that came out, and everybody was really excited about this at the beginning because, we always hear these stories about these dilapidated buildings in the middle of a farm, and nobody's ever going to use them. They have no value. But I'm telling you, two walls and attached roof, it's got to be covered. Well, they came up with this detached structure exemption, and really, the picture you see there is what it applies to. Your loan is secured by a home, and there's a detached structure to that home. So whether it's a detached garage, detached warehouse, whatever it is. In the past, if the home was in a flood zone and the garage was not, or the home was in a flood zone, you would have to get that garage covered as well. Okay. But now it's saying, okay, if the home is in a flood zone and the garage is in a flood zone, if that garage is not used as a dwelling, you don't have to get that garage covered anymore. We've also seen the opposite. If the home's not in a flood zone, but the garage is, in the past, you had to get that covered. And that seems so ridiculous to so many people. Well, now they say, okay, well, if the garage is in the flood zone, but the home is not, we don't have to worry about the garage anymore. but it's only if that detached structure is not also used as a dwelling. So they said, well, we're not going to come up with a bright line test to tell you whether it's a dwelling or not. You have the best knowledge. So if you go into that garage and there's like a cot and a jar in the corner, is that a dwelling? I'm not sure. Would you call it a dwelling? Those are the things that you want to have in your policy and in your procedures whenever you utilize this detached structure exemption. But detached structures that are used for commercial or ag purpose or other business purpose, they still need to be covered. They're not subject to this exemption. Now, our residential condos are typically covered under a residential condominium building association policy. This is our RCBAP. The entire building is covered under one policy. And so the maximum amount of that building coverage that can be purchased is 80% of the replacement cost value or the total number of units times 250,000, whichever is less, because each unit is considered a 1 to 4 family dwelling. So the maximum allowable contents coverage is the actual cash value of the commonly owned contents up to $100,000 per building. So I don't see that too much with the contents coverage, but you're going to look at 80% of the replacement cost value or the total number of units times 250,000, whichever is less, to get to your coverage amount. So we see this a lot of time where maybe the RCBAP is not sufficient. It's not sufficiently covering the condo that you have because their coverage is not high enough. So then you have to work with the borrower and then sometimes the association to come up with a higher amount and why. Commercial condos are different. Now we're talking commercial condos like a strip mall like you see here. So the unit owner can only purchase contents coverage for that specific unit. So if we have like a sporting goods store or whatever, that sporting goods store can only purchase their contents coverage. But if your customer owns the entire strip mall and the structure, then they would be purchasing the flood insurance for the entire structure itself. In the event of any loss, up to 10% of the stated amount of the contents coverage could be applied to losses for interior condo walls, floors, and ceilings. So you just want to make sure that your customer is knowledgeable of their impact and their risk whenever they're in a flood zone. So cooperatives and timeshares are similar but different. So cooperatives are different in that they're not covered under RCBAP because the ownership interest is different in a co-op versus a timeshare versus a condo. So in the co-op, you're looking at them being individual units, even though they could be in a big cooperative building. They're individual units. They have to be treated as such. There's no building policy for them. So they have coverage up to 250,000. Our timeshares are governed by jurisdiction. So, we look at those more as, if you think about it, when you go on vacation, typically you go to a condo, there's timeshares there, you get the little, come see our timeshare and we'll give you, a tour of whatever. You get those nice little promos. It's governed by the jurisdiction, so you can have fee or real estate ownership or non-fee interest. So it's sort of like a right to use that timeshare itself. They can be covered under an RCBAP. So you want to make sure that you understand whether you have just a condo or a timeshare and how that is structured. Okay, so I promised you calculations, and I hope everybody, and this is like right after lunch for everyone. So just what you want is a big calculation, but I'll walk you through it. Okay, so we're going to have a loan amount of $250,000. We have one structure that's a 1 to 4 family residence, so our NFIP max there is going to be $250,000. Our insurable value for that structure is $175,000. We have a second structure in this situation, and it's a multifamily dwelling. So our multifamily NFIP max is $500,000, and our insurable value for this property is $275,000. There's no contents taken as collateral on either property. So we have our loan amount, $250,000. We have our NFIP maxes. So we have $250,000 for the first structure, $500,000 for the second structure, for a total of $750,000. We add our insurable values together, and now we have a total of $450,000. The minimum amount required for these structures is $250,000 spread among the two. Again, they don't care how you spread it, just make sure you document it. In our second calculation example here, we have a loan amount of $1.2 million. Two commercial structures here. So the NFIP max is $500,000 per structure. Our insurable value of structure 1 is $475,000. Insurable value of the second structure is $500,000. Oops, now we have contents. So contents for structure 1 was taken as collateral, and the NFIP max there is $500,000. Then we have our insurable value of $350,000. So our loan amount is $1.2 million. Our NFIP max for the structure is combined $1 million, and then we have our $500,000 max for the contents. And then we look at our insurable values, our structures plus the contents. When we're looking at this, our lowest value is again the 1.2 million. So we would spread that among the two structures and the contents. In our third calculation example, and I promise you this is the last one, we have a loan amount of $450,000. We have one structure is a 1 to 4 family residence. We have a second structure that is also a 1 to 4 family residence. The NFIP max for each is $250,000. Our insurable value for structure 1 is $280,000. Insurable value for structure 2 is $150,000. We did not take contents at all, and you very rarely see contents taken as collateral for residential structures. So our loan amount is $450,000. The NFIP max is $500,000, but we're going to add our insurable values together for $430,000. So our minimum amount required is $430,000 spread among the two structures. Now, in preparation for today's webinar, we also provided a handout that is, or actually two handouts. We have two Excel spreadsheets. One is for multiple buildings taken as collateral, which includes contents for calculating your flood insurance coverage. So you plug the numbers in. There's some drop downs in there that automatically populate some of the information for you to get to whether you have sufficient coverage in place. The other spreadsheet that we gave you is for condos. So test them out. What we see a lot of the times is our clients will use those. They'll put them in each file, scan them in if you have electronic files, just so that your flood calculation is very transparent to any third party testing it, any examiner testing it. Okay, so moving on to other concepts, other real estate owned. Interestingly enough, under the flood rules, flood insurance is not required for your bank-owned properties. However, safety and soundness rules say you better have flood insurance in place or you will be cited for a violation of safety and soundness standards. So when you craft your flood insurance policy, strongly recommend that you say that you will get and you follow the practice of getting coverage for your REO properties. Now, I mentioned private flood insurance quite a few times. This is because it has been such an evolution just over the last few years wherever we have private flood insurance in place. So you can get private flood insurance that complies with much of what the NFIP requires. So again, I had mentioned, hey, whenever Biggert Waters, when it was enacted, it also issued a rule directly related to the acceptance of private flood insurance. So this is sort of the timeline you see on slide 36 of when the agencies address the rules. But what exactly do they say? They say you can accept private flood insurance when it meets 6 main elements. So the first one is licensure. You want to make sure that the insurer is licensed. And normally you want to make sure that that insurer is licensed where the property is located. Now, you could have, if I wanted to use my uncle as my agent and he is in another state, if he has surplus lines recognition as part of his licensure, he can actually give me the insure me in the state that I'm in. So if you have that surplus lines recognition, it just means, hey, I may not be located right here, but I can provide insurance elsewhere. It also requires a 45-day cancellation and non-renewal notice. That's similar to giving the cancellation notice that's in our NFIP policies. The breadth of coverage has to be similar. We also have to have the same strength of mortgage clause within that policy itself, and then legal recourse for any issues that come up with that policy. Now, what you're going to see is there are some proposed rules. Right now, you are allowed to accept private flood insurance. And I just thought about this as I was talking. We actually have a private flood insurance adequacy checklist, and we have a private flood, or not a private flood insurance, we have an overall flood policy and procedures sort of bound together. So if any of you on the line would want to receive that, you'll get my contact at the end. please feel free to send me an email. We can get that checklist and that policy to you. But what's proposed out there is, last year they said if your private flood insurance that you get meets the 6 items that we just talked about, financial institutions are going to be required to accept it. You wouldn't be able to turn it away. Then they said, well, there's certain things that would be discretionary. So private flood insurance may be accepted. Well, what's the difference? Between the 6 elements that we just discussed, one of the key elements was that 45-day cancellation policy, right? So if it has that 45-day cancellation policy in there, excuse me, along with the other 5 elements, you would be required to accept it. This discretionary acceptance doesn't have that 45-day piece in there. It just says within a reasonable time frame, they would be notified of cancellation or non-renewal. So that would be discretionary. You would not be required to accept that if it doesn't have that 45-day time frame in there. Then they also said, we want to recognize mutual aid societies. The best example of this is Amish Aid, because up in Pennsylvania, where I'm located, we have a lot of Amish communities, and they don't typically use private flood insurers or the NFIP. They have Amish Aid, and it is one of the best insurance policies out there. So basically, they're saying we'll recognize that as federally okay, like you can acceptable, that you can have that as your private flood insurance or as your flood insurance. Now, the comment period for this ended last year. It has not moved any further forward. So it is still proposed. Whenever you get those private flood insurance policies, you can accept them. You are allowed to, but you can turn them away as well. One of the other things that comes along with flood is escrow. And really, as a former examiner and somebody that's always looking at the risks of a situation, escrow is my friend. I think it's a good thing. Basically, it makes sure that insurance is obtained and maintained for the life of the loan. But in certain situations now, it can be mandatory. So back in January, a couple of years ago, and that should be January of 16. I'm sorry for that. That is a typo. But this applies to loans that experience a triggering event. So if they were made, increased, extended, or renewed, they would have to be escrowed. The flood insurance policy would have to be escrowed. Now, if there was a map change, that doesn't basically make it a triggering event. So you would have to escrow for that flood insurance unless you met one of the exemptions. Now, let me take you back a little bit. Prior to this rule, if you escrowed for hazard insurance and taxes and your property was in a flood zone, you had to escrow for your flood insurance as well. This rule doesn't care what you're doing with your hazard insurance and taxes. If your property is in a flood zone, you have to escrow for it unless one of the exceptions applies. So if you have less than $1 billion in assets as of July 6, 2012, and you were not required by federal or state law and did not have a policy of uniformly and consistently escrowing for taxes and insurance, you would be considered a small lender and you would not have to escrow for your flood insurance policies. But if you required escrow for segments of your portfolio, if your loan to value was a certain amount or whatever, then that was a policy of uniformly and consistently escrowing, and you would still have to comply with this. Now, if you have a loan in a subordinate lien position, if it's secured by a condo, co-op, or other project developments, business, commercial, or ag, HELOCs, you don't have to escrow for them. You can, but you're not required to. Your non-performing loans, you don't have to escrow for the flood insurance premiums. And then those loans with terms not longer than 12 months, even if it's renewed for another 12 months, you don't have to escrow. Now, here's the thing. When you determine that an exception no longer applies, you have to require the escrow of flood insurance premiums and fees if you're not otherwise exempt from the escrow rule. Based on this too, you had to, as of January 1st, 2016, figure out how you were going to notify your customers of the option to escrow. And so you had to notify your customers. If you were not exempt, if you're not a small lender, you had to notify your customers of the option to escrow by June 30th of 2016. A lot of the letters went out and a lot of the customers said no thanks. Whenever they saw that big amount that they had to put into their escrow account, they thought, I'm good. I've been going this long, didn't need to escrow for it before, I'm good. But you can also always offer them the option to escrow. I did talk about force placement a little bit. So whenever you identify inadequate coverage or a lapse in coverage, you have to provide that 45-day notice. That part hasn't changed. Now, you can force place whenever you identify that lapse in coverage or insufficient coverage, but you still have to send out that letter. Here's the thing. We've been saying you are not required to force place on day one being when you identify that lapse in coverage or insufficient coverage. But we've been seeing some of the regulators come down on financial institutions for not doing that, for waiting the 45 days. They said, why are you waiting? You're risking the customer, you're risking your collateral. Why would you wait? So you really kind of take a look at that, put together a risk assessment statement within your policy as to why you're waiting that time frame if you're not force placing on day one. Because you really want to make sure that you have that backed up. And you can charge the customer for the cost of force place coverage on the date in which their coverage lapsed or did not provide sufficient amount. Now, one thing, and I literally just got off another webinar before starting this one, and it was on the mortgage servicing side of things. So if you're on the mortgage servicing side of things, you're dealing with hazard insurance a lot of the time. Well, the mortgage servicing rules say for hazard insurance, you have to do a 3 notice cycle. So 45 days, 30 days, 15 days. That's hazard. You don't have to do that with flood. Flood only says a 45-day notice. A lot of you may line them up together, and that's totally fine, but flood just says 45 days. If your customer comes back and says, hold up, I had insurance in place, here is my declarations page, within 30 days of receipt of that information, you have to terminate that force place coverage and refund the customer for any period of overlapping coverage. There are stiff penalties for non-compliance. So whenever there's a pattern or practice of violations, that's where there's a really big issue. You know, every once in a while we see an isolated violation. We see an issue that's out there. But when we see systemic issues or when your regulator sees systemic issues, that's when the penalties start to fly. So we always want to look for the purchase of flood insurance. Make sure your determinations are timely. You're getting notice to your customer within a reasonable time frame prior to closing, and that insurance is in place prior to closing. You absolutely cannot force place insurance prior to closing or at closing, because what we see a lot of the times is there's a big commercial customer that finds out late that they're in a flood zone. They don't want to purchase the flood insurance, but you don't want to lose this multi-million-dollar loan. You force place it. It is an automatic violation of flood rules. So you cannot do that. The other issue that we see sometimes is with participations. You want to make sure if you are not always if you're the lead bank, regardless of who you are, when you have a loan in place, you want to make sure your flood insurance is sufficient. But when you're going through and you're purchasing into a participation, that lead bank came up with the right insurance amount. We've uncovered a couple of instances in the last few years where the lead bank didn't calculate their flood insurance appropriately, and they were told by their purchasers that they didn't, and they had to increase their coverage. So it's a little bit of egg on their face there. So you want to make sure that you're complying with the rules. Never screw these up. Lots of testing in this area. Be very transparent in your calculations. Now, if you have one violation, is it an automatic $2,000 penalty? Not all the time. Sometimes you'll get a buy and they won't penalize you for it. It depends on the severity of the violation, whether there was any consumer harm indicated by the violation. And then there's no maximum limit for systemic violations. So that's one thing you want to be wary of as well. And whenever there's flood violations, they're typically public. So that's another reputational risk issue that you want to be aware of. Now, as far as record retention is required, you have to keep copies of that flood determination form for as long as you own the loan, and then copies of the notices to your borrowers and services for as long as you own the loan. Now, here's the other thing. You need to also demonstrate continuity and coverage. So you want to make sure that you're keeping at least the declarations pages for all of your flood loans to make sure that you show that continuous coverage, especially on the force place side. Because you're going to show, when the coverage elapsed, your notice cycle, when you put force place coverage in place, and going back to when you renew each of those flood pieces. So each of those force place flood insurance policies. So you want to show that continuity and coverage. if you use a servicer, some of you may use a third-party servicer to administer this process. They can typically provide you a whole audit trail of all the notices that have gone out when the policies were put into place, and that makes it a little bit easier. But if you're doing this manually, make sure you're keeping those copies. So, okay, I've talked a lot and I've given you a lot of information. If there's any questions that have come in, I'd be happy to take them now, but otherwise, I can take them offline too.
Sure. Well, thank you, Angela, for what I felt like a workshop. It was great. And what I'd love to do is open it up for questions. So if you're on the call and have some questions, feel free to chat that in the question box. In the meantime, so Angela's given us a lot of stuff. I'd love for you, if you don't mind, Angela, to give us like a 30-second infomercial, if you would, on Sterling and what you guys do. Definitely want folks on the call to know kind of the services you guys offer.
Right. Okay. So, 30-second infomercial. So we launched.
You can take as much time as you'd like.
Okay. So we launched a couple of years ago, but prior to that, so as Carl mentioned, I was an examiner, and it's funny how life sort of comes together. My partner here at Sterling, Lisa, she was the director of operations for one of the banks that I was an examiner for. And so for years, I would go there, I'd be the examiner, she was the banker, and we just kind of kept in touch. And, we kind of went our separate ways and ended up at a consulting firm a few years later and did that for a while. And then, this was about the time that Dodd-Frank was really at his heyday and things like that. And we thought, you know what, we see compliance go in a whole other direction. We need to take this thing to the next level. So we launched Sterling and never looked back. I mean, it has been an amazing ride, and we do it all. We do everything compliance related. We do the audits, we do BSA reviews and audits, we do policy writing, we do a lot of custom policy writing actually. We have our Beacon service where it's basically unlimited access to us by telephone or email for any compliance related questions. So it's kind of like a hotline or a helpline, whatever you want to call it. We also have our Navigator newsletter, which is our monthly newsletter. We try to issue 1 to 2 tools with each edition of it. So, we're very much, our philosophy is we're going to give you everything to make your life easier. And it's not about nickel and diming anybody for a tool here and a tool there. We just want to give it to all of you because we know what it's like to be in the trenches and to be dealing with all of these rules and not having the time, the energy, or the wherewithal to really digest it. So we like to make it fun, and we like to make compliance fun and not boring. So I guess that's my infomercial.
No, that's great. That's awesome. And we'll make sure that there's lots of questions about the slides and the handouts. We will get those to everybody on the call. There'll also be a recording of the call that goes out later this week. Here's a couple of specific questions. One is there a maximum limit for flood insurance for a single property, either commercial or residential? Follow-up, I heard that there is, and that therefore there's a maximum that can be paid out for a claim, and then the limits the maximum insurance cost that should be charged for a property. So is there a maximum limit for insurance for a single property, either commercial or residential?
Okay, so this is a very good question. And we get this a lot. There is not a specific max, but if your customer wants to take out a $10,000 deductible so that their premium is much cheaper, you have to be very careful of that. And what the regulators are basically saying is if you do that, you better have a way of determining whether that customer can have that deductible available to them should something happen. So it's a very risk-based decision. They do not encourage it in any way, but sometimes you see this more on the commercial side of things, or on multi-million-dollar residential properties where they really just don't want to pay that huge premium all the time. And so what we've seen is either a detailed analysis of the customer's liquidity, or they actually ask the customer to put that premium or put that deductible away into a CD and sign that CD to the bank for the entire time that they have that mortgage outstanding. So if something would ever happen, that CD is right there, it covers the deductible, and then neither party has to really worry about it. So that would be a good control to have in place.
Got it. Man, a lot of good questions. We'll get to all that we can. So, do the regulations provide any guidance regarding amounts of deductibles or coinsurance?
So that's very similar to the first question. There is a schedule out there, and I don't have it at my fingertips, but they did have a schedule out there, but I believe it's pretty outdated as far as they were looking at the deductibles. But Carl, as part of the follow-up, I can look at that because the schedule that I have, I know is outdated.
Okay. Let's see. Another one, for construction loans, we get a lot of kickback from insurance agents where they will not place flood coverage without the project already started. Recommendations. I'm using
Okay.
pushback. Well, yeah.
Aside from giving them,
yeah,
the insurance companies can be buggers about this stuff. Okay, so if the project hasn't started yet, there is a specific regulatory citation that you can provide them to let them know that this is required by law and it is permissible under regulatory rules to insure it for the full amount for the development loan. So I'd be happy if whoever asked that question, I'd be happy to provide it to you if you wanted to give me an email address or something, or send me a quick email. I can give you the regulatory citation for that, but that would be the way to go, or find another insurance company. My thought was, you're not willing to insure this, go somewhere else because it is required and permissible under the law.
Got it. Probably got time for one or two more. Can we refinance a loan with existing forced place flood insurance?
Yes, you can do that. But you still have to give your notice. You still have to give flood notice. If you're giving additional monies, you should not do it. So if it's like a cash out refi, or if you're giving more money, you should not do it. But if it's a straight up refinance, and it's forced placed, you can do that. You just have to make sure that you get a new determination, you do the new notice.
Gotcha. All right. Let's see. What are your thoughts regarding the bank's requirement when flood zone discrepancies occur? There appears to be conflicting information in the reg final rules. Do we need to stop closing or force place if currently on the books?
If it's currently on the books, you can force place until you get it straightened out. Now, what happens a lot of the time is if you have a discrepancy where they're saying, it's in a flood zone, and you're saying it's not, you're saying it's in a flood zone, and they're saying it's not, and they don't want to have it covered, and they want to amend that map or repeal the map or whatever, you actually have to have that property covered before it closes. So you cannot force place at that point. They would have to pay for coverage until that letter of map amendment is issued. So that is a hot button question, because there's two kinds of discrepancies. One is prior to loan closing, where one says it's covered, one says it's not. They don't want to pay for it. Well, you can't force place, and you can't close the loan without the insurance in place, and they would have to go through that appeal process. There's another discrepancy out there where maybe the insurance company says it's zone A and somebody says it's zone AE, or your determination's different. That's something you have to work out between the determination companies and the insurance agents. And I understand a lot of the insurance companies are very difficult to deal with where that's concerned. So, my thought on that discrepancy is, go back. You can look at the appraisal. You can tie it to the determination itself, look at the prior flood maps, and go back to the insurance company. If the insurance company is still giving you an issue with it, go to a different insurance company, because there are insurance companies out there that will work with you.
Cool. All right, last one
Okay.
and I'll squeeze you under the wire. This is a longtime friend of mine. Would a bank be taking a risk to estimate replacement cost using a resource like Marshall Valuation Service? I think that's Marshall and Swift. Maybe what he's referring to, the CoreLogic product.
Right. Yeah. So that's typically part of the cost approach anyway. Whenever they go to the second page or the third page of the appraisal. So Marshall and Swift is typically used for that. As long as you have a sound methodology for getting to your replacement cost value or your actual cash value, you don't have to use the appraisal to do that. Because sometimes if you do like in-house valuations or you don't get a full appraisal, you're not going to have that option. So yeah, you can use other versions, whether you use Marshall and Swift. You can look to sometimes the hazard insurance policy for the replacement cost. You can look at if they have existing flood coverage in place, look at the replacement cost on there. You just want to make sure that you're not asking them to be covered for something that they wouldn't be reimbursed for in a claim.
Awesome. Well, that is all the time we have. Angela, you have been so generous. We have lots of follow-ups for folks on the call. If you have any other further questions, feel free to reach out either to us at Mountain Seed or Angela, and we'll make sure to connect everyone. So thanks everyone for the time. I think next month we're going to be hosting, I believe, Boxwood Means. Still finalizing that, but talking about small balance commercial loans and evaluations and some of that stuff. So thanks so much for Angela, and look forward to talking to everybody soon. Have a great day.
Thank you.